Hi, this is Nilus Mattive for Money and Markets TV. In uncertain market environments like the one we're facing now, I think investors' primary concern should be stability and safety. That's why I tend to recommend more defensive sectors, including utilities, consumer staples, pharmaceuticals, and other industries that don't need overall economic strength to excel. In fact, I think these types of companies should always form the core of your portfolio. However, if you want to be more aggressive and take risks on some contrarian plays, you could consider cyclical stocks, such as industrials, materials, and consumer discretionaries. These companies are tied to the health of the U.S. economy, so they haven't been very popular lately. I limited my search to companies with certain characteristics. First, a payout ratio of 60% or less, meaning they have a reasonable cushion to support their future dividend payments. Second, an increase in their payments of at least 5% in the last 5 years. To me, this indicates special strength because that's when the real financial crisis really got going. And third, an annual yield of at least 2% to guarantee that you're getting a return above the market average. Finally, to narrow the list down further, I eliminated companies that aren't well liked by other Wall Street analysts that I respect. These filters produced a list of 38 names, but one consumer discretionary stock really stood out: Target. It's boosted its dividends by more than 27% since 2007, and its payout ratio of 26% suggests there's still plenty of room for future dividend hikes. I was also surprised by how many aerospace and defense firms made the list: Boeing, General Dynamics, Honeywell, L3 Communications, Lockheed Martin, Northrop Grumman, Raytheon, Rockwell Collins, and United Technologies. That's 9 names, almost a quarter of my list. Rather than trying to pick out the best stock among them, you might be better off buying an ETF that gives you exposure to the entire group. The PowerShares Aerospace and Defense Fund and the iShares Dow Jones US Aerospace and Defense Fund are 2 good choices. Of course, these won't give you the same yield as a single stock, but you would be taking on less risk. I'd also like to mention a couple other interesting names that popped up. For example, International Flavors and Fragrances is a chemical company whose business position I've admired for a long time. And then there's United Parcel Service. UPS trades at 16.4 times earnings, which isn't dirt cheap, but it does have an annual yield of 3%. If you want to bet on a global economic recovery, UPS might be a good way to do it. That's because as businesses pick up, more packages would start circling the world, and UPS would see its volumes and profits rise. Just remember that higher fuel prices would cut into those numbers. In fact, that's true for a lot of the companies I mentioned in these cyclical industries. I'm not recommending you go out and buy any of these stocks today, but I do think many of them merit further research if you're looking to add a bit of edge to your existing holdings. I'm Nilus Mattive for Money and Markets TV. Thanks for watching.